Well, hello everyone, and just a quick update from us at the end of a wild week in financial markets. As we have a look at the calendar, quick look across the calendar, we had a raft of central banks out this week. We had the Fed, we had the Bank of England, we had the BOJ, the Bank of Japan, and we have also had the Swiss National Bank. Now, out of the Fed on Wednesday, we did see an interest rate hike. 50 basis point was what was muted by markets and what was communicated by Jerome Powell at his last meeting, but we did in fact get a higher than anticipated figure at 1.75%. Now, wasn't that unanticipated? A lot of market participants were expecting the 75 basis point hike. Now, they were not able to communicate that to markets after the inflation print of this day last week of 8.6%, a little bit over the top of consensus of 8.3. They were in their blackout period at the Fed and could not communicate that to markets. So markets had to take the lead on this one. There was a 97% probability of a 75 basis point hike. Markets were largely expecting it coming into the release on Wednesday. Now, what we did see out of the Fed was some economic projections, some updated economic projections. Now, obviously, it's pretty hawkish coming in over the top in terms of an interest rate hike. 75 basis points is strong itself, and we did see out of the economic projections that the Fed were expecting their interest rate to be at 3.9%. 3.4% by year end, over the 1.9% that they expected back in March. Also, we had Jerome Powell at the press conference saying that there is potential for another 75 basis point hike at their next meeting, likely to be 50 or 75, but there is potential for another similar move at their next meeting. They are not so sure going forward on the guidance, but with a prediction for a 3.9% interest rate, 3.4. Well, I keep messing that up. It was 1.9 predicted, 3.4 at the last projection. 3.4 is the current projection for the interest rate, the federal funds rate at year end of this year. So that would say to us that we've still got 1.25 plus 4. We still got certainly like double the interest rate as it is now. 1.75, double that is 3.5. So we're expecting somewhat the Fed have communicated potentially double the interest rate by year end. So that is something we need to keep in the back of our mind, and yeah, it's definitely something that we can look to act on if they continue to hike rates at the speed that they are. Following on from that, then we did have yesterday the Bank of England. Yesterday, a little bit closer to home, we had an interest rate hike of 0.25% of 25 basis point, from 1% up to 1.25%. Now, we initially had a dovish reaction. We initially had a dovish reaction to the release, but then that's since picked up after, and we did move back higher. Now, we did have 3 dissenters from the 25 basis point hike. We did have 3 dissenters calling for a 50 basis point hike. Now, markets had been expecting potentially a 50 basis point hike. There was an 80% chance priced in of a 50 basis point rate hike, and when we did not get that, when we got 25 basis point, that sent sterling lower, that sent cable lower, and was a dovish reaction initially. And then once markets realized that 3 of the 9 voters did actually advocate a 50 basis point move, that was seen as then a hawkish step, and then sterling had then moved higher off of the back of that. Apart from that, then we had the Bank of Japan earlier on this morning. I've stuck to the script. They are the one central bank that is lagging. We did previously have another central bank that was lagging in terms of the interest rates. It's not actually on this calendar for some reason, I don't know, but we did have the Swiss National Bank yesterday, who did for the first time since 2007 increase their interest rate. Now, markets were not expecting this. Markets were there'd be people would have been expecting it, but markets were not expecting it in terms of what the central bank had communicated. They only have these meetings once every quarter, and in Switzerland they do a little bit differently to the rest of the world. So there was a kind of chance, do they hike by 25 and then maybe have to do 50 at the next meeting, or do they be a bit prudent and go straight in with the 50 at this meeting and then just cross that bridge when it comes to it a little bit later on down the line when they've got more information as to how the economies will perform. So then we look over at the charts. We get over at the charts now. In terms of the Fed, a little bit undecided, probably on future monetary policy guidance. But at the next meeting, 75, 50 basis points. Slightly hawkish. 3.4% interest rate. Back at year end, that's slightly hawkish. But that just proves to us that a lot of the hawkishness was priced in, and we did see the kind of move lower yesterday. Now, this could have easily been driven by sterling sterling or cable moving higher and kind of dragging the rest with them. We did see some positivity around the eurozone. Step back in over the last couple of days with their emergency meeting, to relieve some of the stress in markets around the eurozone. So we did see a bit of a positivity for the euro, bit of positivity for sterling yesterday, as well, and that has kind of resulted in a kind of more broader based dollar move. You did see dollar Swiss then as well. Dollar Swiss has moved lower, as you can see here. Big massive bearish candle. Dollar Swiss was down 270 pips or something at one point yesterday. It was a pretty wild ride in terms of FX. Now all this has contributed to the dollar lower. Is this a kind of a result of Swiss strength, sterling strength, and a bit of euro strength just kind of dragging the dollar lower, or is this a case of dollar weakness? It remains to be seen. We can look across at some other assets to kind of give us an indication of that. What I was looking at personally was this. If you look at the 10-year yield again in focus when we come around to interest rates, you can see the big higher time frame level. We failed once, twice, three times over the last 10 years at this 3% level. We have come up to tag 350 over the course of the week, but we have since showed a bit of a unwillingness to break above that 350. We can see, I'll probably go down to 1 hour time frame. You can see this double top up here. We've moved lower, double top off 350, and we've moved lower. A bit of a break through the neckline, retesting it. Does signal some bearishness in terms of the charts. Now it would be interesting if we could move lower from here, get back towards 3% and kind of fail once again at 3%. That would be certainly interesting for me. That is likely to prove kind of negative for the dollar and supportive for stocks, which is probably needed. Really, a little bit of a pullback on these assets would not be unwelcome. Would not be unwelcome. I don't think we can see then when we move to the S&P 500. We got a bunch of assets to cover today, but again, you can see this big move lower. Every time, if you look back through here, just to look previously what happened. Every time we've broken through these lows, a new lower low created here. New lower low created here. We then shot back higher. Again, new lower low created here. Across here, new low created, we then shot back higher again. If I just clear up the chart a bit, we made a new lower low this week. Each of the last kind of 3 or 4 times we've done that, we have had a pullback pretty soon after. So I would be expecting a pullback on this, just looking at the chart. In terms of the dollar can continue to move lower, and if the US 10-year yield can continue to move lower and alleviate some stress, this is probably likely to be supportive, at least short term, for stocks. So a bit of a bounce back is definitely not out of the realms of possibility. In terms of the other markets, the other charts, you can look at dollar yen here. Dollar yen moved lower in line with that kind of broad-based dollar weakness as of yesterday, and as of the Bank of Japan doing nothing today, that has shot back higher in a bout of yen weakness. Now, the Bank of Japan did communicate to markets that they would be willing to step in if the situation with the yen got too bad and it continued to move higher. There was talks muted of 135 that they would defend the 135 level, and also the 140 level you think they might defend. So I think the Bank of Japan are reluctant to they do not want to have to jump in and kind of manipulate it themselves, but it is definitely something that they are looking at going forward. I think they probably want to adjust their monetary policy settings and try and fix it a bit more organically, but I will leave that with them. But again, that economy has struggled for so much for so long that it could probably do with some inflation, to be fair. So I will leave that up to them. So that concludes this week then. Pretty wild ride in terms of FX, certainly this week, in terms of stocks this week, in terms of everything. Pretty wild ride in terms of everything this week. Next week we've got a relatively quiet economic calendar. We've got a few data points to look at, to go off. We've got some inflation figures out of the UK and Canada next Wednesday. Got some PMIs out of Germany and the UK next Thursday. And then Friday, we've got a bit of data on Friday, some consumer confidence figures and retail sales figures out of the UK, and some other figures out of Germany, and then a couple of housing figures out of the US over the course of the week, existing home sales and then new home sales, Tuesday and Friday of next week. So yeah, we'll cover that a bit more in due course at some point next week, but a relatively quiet economic calendar throughout the course of next week. That is it from me then. That is it from me at the end of a pretty crazy week. Today, it's pretty sunny outside, 32 degrees here in London. If you're in the UK, it's pretty warm in my hometown as well. If you're back in Ireland, enjoy the sun. You might not get that much of it over the weekend, as we are predicted for a bit of a dull weekend, I think. So enjoy today. If you can, do get out and enjoy the sun. Get out and have a bit of rest and relaxation for yourself. Spend some time with your friends, with your family, and get some rest into you, ready for another week of trading next week. So that is it from us then, folks. Have a good weekend, and we'll speak to you again next week. See you then.